Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and welcome on into another exciting week in the financial markets. We have the big news that came out over the weekend of OPEC cutting the oil supply by 1.16 million barrels per day, which has the oil price shooting up a bit higher today. And also have some movement in the metals with the gold price back over $2,000 per ounce in the futures contracts, and a lot of interesting things happening. So quite fortunate to be joined once again by Vince, the Professor Lanci of Goldfix Substack and Echo Bay Partners, to make sense out of everything that is going on. So Vince, it's quite an honor to have you back on here with that beautiful brain of yours today. And before we get into all the business and markets, how are you doing today, my friend?
I'm doing good. Thanks for having me back, and thanks for doing this live. I think hopefully people appreciate that, especially when there's a big news item that comes out at the end of a quarter like this one did. Yeah, let's go. I'm ready.
Well, certainly plenty happening, and perhaps the place to start is the news with the oil cuts. This is the second cut we've seen in the last couple months, I believe going back to October of last year, and amongst other things, doesn't signal an indication of a great relationship between Saudi Arabia and U.S. But what could you say here about the move by OPEC over the weekend and where that leaves us with oil right now?
Well, I mean, there are a couple reports out explaining the rationale, but it really comes down to OPEC has figured out, or they believe, that the U.S. has no intention of buying back its SPR short oil at current prices, even though they said they would. And upon realizing that, and also realizing that because of the banking crisis, believe it or not, it's harder to drill for fresh oil, because without the banking financing, you can't do that. So OPEC, which essentially controls the spice now, said, we're going to cut production. And in doing that, they also were re-solidifying their relationship with Russia, which had cut a month or two ago. It's very, very bad news for Western economies for multiple reasons, which we can get into. But that's what happened. They're cutting back production about 1.2 million barrels a day, which really is going to come to about 1.6 million barrels. And that's good for... It's good for a 7% pop in oil, which is also going to directly affect precious metals. They're not used to, but it is now.
Yeah, and I'm going to pull up the oil chart so we can actually take a look at that. There you see the crude oil futures up $4.91 at 80.58. And interesting note from the great Craig Hemke in his column this morning at tfmetalsreport.com, which certainly I highly recommend for people to be reading through every day. And he says, sounds like put a tweet there. Sounds like the White House told Saudi Arabia earlier this morning they would refill the SPR to support oil prices. Saudis then realized they were getting played and took matters back into their own hands. Did the U.S. miss the opportunity to begin refilling that Strategic Petroleum Reserve? We've heard a lot of talk about that, but so far it seems like it's just been getting drained, and we haven't really had the refill part.
It's actually worse than what's being said right now. As a trader, I track these things. So when we sold it at an average price of, let's say, 96, when we had to, more or less, we said we'd be a buy. We said we'd be a buyer in the $90 area. Then when it went to 90, we said we'd be a buyer in the $80 area. Then when it went to 80, we announced more sales. And then we said we'll buy between 67 and 72. This all happened. So it's basically like someone's short. Think of it this way. We're short the market, and every time it drops, we say we're going to buy it, and then we don't. We buy it, and then we don't. So the market is kind of getting spoofed, or rug pulled is probably the better word for it. And when it broke below $67, and the U.S. did not buy as it said it would again, OPEC, which had previously said they would step up and reduce production if they had to, said, okay, number one, you said you were going to buy and you weren't, and you had said that you wanted stable oil prices between $70 and $80. So you didn't buy at 67. Number two, you released more oil, which is a slap in the face. And number three, here's the poker play that you're probably not going to see in too many other places. When we released the SPR, the most recent release, France also released. But France's SPR release was so small that it kind of tipped our hand that they weren't really into it anymore. So this is I'm paraphrasing Goldman now. So basically, the lack of commitment aside the US on the SPR release says that the alliance on the oil stuff is breaking. And OPEC said, the heck with it. We're going to cut production. And they did. And it's significant. It's significant because we can't pump oil quickly enough to bring it back online. So it's a big deal.
So do you think this was a direct response to that failure to do so, that OPEC was responding to the continued promise to buy back that oil, and when they didn't, that this see a direct cause and effect there, or how would you frame it?
Yeah, I mean, if we were being lawyers about it, I would have to say that no, you can't prove a quid pro quo. And in fact, they went out of their way to tell everyone this wasn't OPEC cutting; these were voluntary individual cuts. So it's not a cartel. Everybody just decided to do it on their own, like out of the clear blue sky. But more to your point, look, my guess is when you're playing a game of poker and we're saying we're going to buy it at 70, and they were saying, OPEC was saying we'll sell it at around 80, well, and you don't buy it at 70, well, now it's everyone's bluffing pots. So they probably had this plan in their back pocket and were waiting for an opportune moment to do it. And this was extremely opportune. We didn't buy when we said we would. The end of the quarter happened. There's a lot of fresh shorts in oil, and there's a lot of new longs coming into precious metals. So you raise oil, you raise precious metals, and that's what's happening. The government, it has its hands full, keeping a lid on, tamping is the word, multiple markets now. And so the answer to your question is, we can't prove it's a quid pro quo, but it's a tactically brilliant moment that they did it. Very fortuitous, put it that way.
Yes, in the land of things we can't prove, but perhaps might not be a coincidence. We'll file this under that category. Vince, what do you think Putin is thinking as he watches? I'm sure he's caught your episodes over the last couple of weeks, and in addition to the so I mean, I know that helps a little bit, but as he's watching banking troubles, the dilemma that the Fed is in, now seeing things with the oil market in the middle of what we could call a proxy war being played out in Ukraine.
That's right.
And then about a week, maybe over a week ago, he had that meeting with Xi Jinping where they talked about changes that the world hasn't seen in 100 years. But especially like as he sits there and watches the fragility in the banking system, what do you think he's thinking at this point?
Well, I wouldn't presume, but I would say that he's growing more and more comfortable with China as his banker. So Russia is the oil producer, China is the oil consumer, and he's not uncomfortable in his position despite the chronic aspect of the sanctions. And here's what I mean by that. Let's say I'm Putin and I've got bad news. The bad news is I have to keep selling my oil low. The good news is China is going to keep me afloat. And while China's keeping us afloat, we're seeing other good news. Saudi Arabia is going to partner with China to build refineries in China. That means more oil for yuan. Other countries, other BRICS countries are settling oil in their own currency. That's also bad for the dollar. That's also bullish for oil. That's also bullish for the ruble. And he's looking at all these things on his side of the fence saying, well, the bad part is I've got sanctions and it's keeping a lid on my profits. The good part is my partners are holding up their end of the bargain. And then to your point about looking at the US banking situation, he's got to be licking his chops at that because Powell had been raising rates to keep demand for oil down, and it had been working, at least ostensibly. But the banking collapses are a double whammy. First, they're a whammy because if the banking collapses happen, as they have, you need to lower rates to ease the credit crunch. So that means the demand's going to go back up. They have to print money, so to speak. The other one is purely from a Putin point of view. Well, Putin's an oil guy, and he knows that in the US, it happens to be that the banks that got hit hardest by this rate hiking regime were the banks that finance new oil projects. So we're not going to be putting any new oil online anytime soon, any fresh new oil online anytime soon. So tactically, and I do believe Putin is as tactically adept at things as we are, KGB guy and all, right? He probably saw this as a very good opportunity, especially with the end of the quarter and the pump primed for precious metals to rally as well. Yeah.
Well, that makes a lot of sense. And perhaps in the midst of this, you also mentioned the Federal Reserve. Where do you think that leaves them with the decision for their May meeting? Because obviously, if we have oil prices going higher, that's not really going to help their efforts to allegedly fight inflation. Where do you think that leaves us? And I'll pull up as we see today.
Yeah, sure.
Markets pricing in a slight favorite of another quarter point rate hike, close to 50-50, 44-55. But what do you see happening in that next meeting now?
Well, it helps to think about it before and after, right? So before, the Fed had been telegraphing through their mouthpiece, for lack of a better word, and through other venues, that the May hike, if it happened, was going to be the last hike. So there was something like an 80% chance of the market anticipating an 80% chance of a last 25 basis point hike, and then sideways to lower, depending on what breaks. Well, this really turned a punch bowl for Powell, because, as you noted, goods inflation was the only thing we had going for us. Goods inflation had been depressed somewhat. I mean, it was still there, but it was at a lower rate. What did President Biden say? A 30% reduction in inflation, something like that. Sorry, that's an aside, but that's just obscene that he would say that. Yeah, exactly. Nice. You had that ready. I can't believe. I'm sorry. I don't want to. It's profane.
That Joe Biden fist pump threw you off your game there. You got to be careful.
It did. I have to. You triggered some trauma. Okay, so.
Speaking of trauma, just wait till people see what we have planned for the end of this episode.
That's right. That's right. The Janet Yellen reveal, the unboxing, we'll call it, right? So back to the point. The point is, Powell wants to stop raising rates, period, because banks are failing. But Putin said, "Oh, you're done hiking? Well, now we're going to make oil more expensive." And so Powell may be considering hiking further. I don't see it in the marketplace yet, but it really is not something that's going to make this guy happy, because we never really got service inflation down. Service inflation, meaning labor costs, even though nobody's making the amount of money they need to survive inflation, have creeped up. And in creeping up, that kept inflation, has been keeping inflation buoyant. If goods inflation reignites, and let's face it, I mean, whose food has gotten cheaper in the last 60 days? No one's. So goods inflation isn't lower. Goods inflation is just going up at a slower pace. Oil comes up to $80, which is where it is today, or higher, 80.62 last. Then that goods inflation is going to come back. Everything is resting at a higher level now, higher lows, so to speak. I think Powell is he's really kind of shitting a brick, because if he doesn't raise rates again after this, then goods inflation is going to come back. And if he does raise rates again, then we're going to have more bank failures. Guaranteed, every 25 basis point hike from here on in makes something break. What breaks, we don't know. But at this point, it's all bad portfolios being unwound. So to answer your question is, he's probably, shitting a brick a little bit. Yeah. It's not really good. It's really bad for him.
Yeah, it doesn't seem like an ideal situation. And then here we look at the probabilities going out, forecasting the rate hike, and then markets pricing in a cut in July, another cut in November, cut in December. And while I guess there will be a lot that plays out in between now and then, I would reiterate that at Jerome Powell's last press conference, he again mentioned what he said in December about how his the summary of economic projections, their target Fed funds rate at the end of 2024, I believe it was 4.1%, then 2025, 3.1%. So, I mean, we're talking about, I don't know if you want to call that semantics, but whether it's this year or next year, even he's saying that there are cuts coming. So,
Yep.
will be interesting. And before we get to gold and silver, did have one question come in already that is related to gold. This is coming from the Jakester, a big Professor Vinny fan. And he asked your opinion on the correlation between gold and oil in the next 3 years.
Yeah, that's a good question. We all looking backwards, we know that theoretically oil and gold should be positively correlated. The higher oil goes, the higher gold goes. Oil creates inflation, inflation translates to gold. But we know that the transmission mechanism has been very inefficient over that time period, primarily due to, I think, rehypothecation sitting on silver and gold. But now with the break east and west, you're going to see a tighter correlation between precious metals and oil. So as oil goes up, it used to be, unless it's a war, as oil goes up, gold and silver can go up. They might not. They should go up over a 3-year period, to use your time frame. But on a day-to-day basis, you can't really look at that. What we're seeing now, at least what we saw today, is oil and gold and silver all went up on the news. Now, I know initially gold and silver opened weaker, but that was nonsense. That was a spoof. But to answer your question, over 3 years, I think whatever oil does, gold does over the next 3 years. So if you're bullish, I like to say, if you're bullish gold, buy silver. Okay? I'm going to be saying probably in 6 months, if you're bullish oil, buy silver, because that's going to start transmitting more efficiently from oil to precious metals. And that's what I think. I think that's going to be a more robust relationship going forward, especially if every dollar Putin makes is going into gold, right?
Yeah, and I will pull our gold chart back up because we do still have the price of gold in the futures contract back over $2,000 an ounce. Has crossed that level briefly a few times in the past week or two. Do you think we're close to the point where once it finally goes through a bit more convincingly that might be the last time we see it go below 2,000, or is this a situation where in a couple months maybe we'll be seeing 1,900, 1,800 gold again, or are those days coming to an end?
They're coming to an end, but you're going to have pushback by the West to keep the price of gold in dollars at a more reasonable price. And when I say gold, I'm referring to silver as well. We'll touch on silver specifically in a minute. But I think if we look at what happened last night and today is a pure microcosm of what's going to happen over the next 5 years. Oil gaps up $5. Fine. Right. Gold opens lower in Asia in a thin market. Why? We don't know why. We don't care why now. Normally, we care about precious metals being bought in Asia. I don't care anymore. I want to know what it's going to happen when it hits Europe and when it hits the US. By that, I mean, Europe had been a seller, the slam downs come at 5 in the morning and 8 in the morning, Eastern time, in Europe when London opens. But lately, you look at the chart lately, you're going to see those 5 and 8 a.m. periods as being times that the market's been bought. So let's go to last night. Last night, oil opens up, and you say, oh, okay, we had the highest quarterly close ever. That means there's going to be buying of precious metals too. Why are precious metals lower? I don't care about last night. I care about it coming into the US. And sure enough, as we hit Europe and the US, silver and gold had a very, mighty rally. off the lows. Would you say, you said gold was up almost 40 off the lows, right?
Mm-hmm.
Okay, so we're getting to your 2000 number. Now, domestically, the awareness has been raised, and you're going to start seeing right now, you're seeing it today. Today, you saw funds and we'll call it boomer investors put money back into gold. Not as much silver yet. They don't do it that way. US investors don't buy silver first. Asian investors do, except for China. So I think this is for the next 72 hours. Above 2000, you had buyers get in. Today, you had some hot money get in short term, and that hot money bought silver as well, but not as much. In the next 48 to 72 hours, I believe you're going to see the banks have a concerted effort during thin hours to push this market, these markets lower. And the way they like to do it in times like this, you can take this to the bank. When everybody wants to buy gold, as they do right now, because of the whole central bank thing, what they'll do is they'll take advantage of that, not by spoofing gold lower or selling gold lower. They'll take advantage of it by hitting silver when there's nothing going on. They hit silver when it's nothing going on. It makes the buying in gold get a little bit nervous. The buying in gold sells off. And then the whole thing drops and they cover their shorts. That's one of their methods. So in the long term, you will see gold lead higher. And in the long term, you will see silver follow and then overperform. In the short term, you'll see silver lead lower and gold lead higher. So that's tactically how to look at it. But with regard to the 2000 number, I have to be honest. Of course, we're going to see below 2000 again, because that's what they're going to want to do, you know. And in fact, the spot is still below 2000. So you'll see when you see the press, they'll say gold is below 2000. They're not going to talk about futures because it makes them look bad. Same thing with silver. Silver below, we're in a different area for silver right now. Between 18 and 22 is historically where hedgers hedge. We're above 22. We're above 24 now. We're about at 24 now. The market is not a sell until it gets below 22. This market is a buy now. And you will see silver catch up as gold stabilizes above 2000. And I think if it settles over, I think there's going to be buying for the next 90 days in precious metals. The question is, how aggressive will the sellers be? That's my answer.
All righty. And we did have a question come in. Where did that one go? We had a question that, yes, from Mitch Connor. Will silver rise in market value? Could you do a forecast? You touched on that a little bit. Although I'll add to that, if I may. Do you think the fact that at least numbers reported last year were a deficit? We've had miners come on quite frequently on the show, talk about how projects aren't getting launched at the current silver price. I mean, where do you stand on that, of whether we eventually hit some sort of gap? We've seen the COMEX stockpile go down, LBMA stockpile go down. Do we reach a point where there is an issue in a delivery, or there's an actual shortage, or how do you factor that in, along with Mitch just asking about a forecast as well?
Yeah, I've done forecasts before, and I'm usually off on my timing. And it's really, I'm not a forecaster. I'm a forecaster very short term and very long term. But in that sweet spot, people like, oh, I think silver's going to hit $26 in 90 days. I'm not very good at that. And I think most people are not very good at that, but they like to say that they are, because in 90 days they hope that people forget. The answer is there is a supply deficit. Mines are not profitable. We're waiting for all these pieces to line up. If copper is so important for green energy, why is no one talking about silver? Even though silver is as important in different applications and will grow in importance. If there's a deficit in silver, why isn't it translating into price? That's another one. The other one is why is gold attracting attention and silver not right now, or at least not historically? And I think you're looking at a
Tim,
generation. Yeah.
may I toss in there just because a related question to what you were just those scenarios you were offering? We had someone ask, do the derivatives need to fail for silver and the metals to find their true value? So is
Oh,
that
okay. That's actually let me touch on that. Do you remember? I don't know. It was close to the end of last year when J.P. Morgan and Citibank pulled their derivatives. We're speaking about gold here specifically. Pulled their derivatives off of the FX bucket and put it back into a gold derivatives bucket. That was them announcing that they had derivatives risk, and the fact that they announced it means that it's on people's radar. When you now you go a little bit forward, and you've got Zoltan Pozsar made his comment about Goldmageddon and how the derivatives books are the Achilles heel for the banks right now, especially on the precious metal side. Now, that's a big problem. What you're not going to see, and you're seeing this, what I'm saying happen right now. The government wants the biggest banks to not have a derivatives book problem. Okay, so let's pretend that all the banks in the world end up closing shop except for JP Morgan. All right, that's what's happening, right? That's what's happening in the custodial situations. It's all being concentrated in one bank. And at the extreme, it will be concentrated in that one bank. And their derivatives book will not fail. Their derivatives book will not fail because they will absorb all the risk and the government will bail them out. So the answer is, will we see a derivatives book fail that is the trigger for silver and gold to reach proper highs? Let's just stay with silver here. You'll see it in gold before you'll see it in silver. And here's why. They'll bury it in the news and they don't put silver risk on their books to be reported. The government doesn't know what their positions are. So the thing that's going to get precious metals at a higher price, stable, believe it or not, is not going to be a derivatives book, in my opinion. It's going to be a miner. You're going to start seeing the mines consolidate vertically. Smaller mines that are unprofitable will get bought by other mines. So you'll see gold consolidate as the price goes up. You'll see silver consolidate here. You're going to see vertical integration. You're going to see smaller companies roll into the hands of bigger, more properly run companies. Now, I don't know the miners individually, but I do know that the trigger is going to be when there's less and less mines handling the business. And you're going to see more and more smaller derivatives books cancel out. And it'll be like an OPEC situation. The price of silver then goes up entirely because of US domestic demand. So I don't think we're going to see the headlines on the big derivatives book failing. I think it's going to happen though. Hope that helps.
All righty. Along with derivative books, something that we heard more concerns about recently was Deutsche Bank. Curious where you think things are with Deutsche Bank right now. I will pull up their chart, but some subscribing to the view that they might be the next, I guess we don't say the next Lehman anymore now. Are they going to be the next Credit Suisse? Where do you think things are with Deutsche Bank at this point?
Deutsche Bank is JP Morgan for Europe. That's what they are. That's how important they are. So you're not going to hear about a problem. You're not going to see Deutsche Bank. Now, all these things I'm saying, it sounds like I'm being calm. I'm not. I'm just saying the people in power have a disproportionate amount of control over the information that comes out. So you're not going to see, if Deutsche Bank goes under, you have a deflationary collapse, right? So, and this is the end game, all right? You have a choice. Let's pretend there's only one bank we're talking about right now, Deutsche Bank. If Deutsche Bank goes under, you have a deflationary collapse in Europe. Money stops moving. I don't care how much you print. Money stops moving and people stop loaning to each other. Counterparty risk becomes the big problem. Deutsche Bank went under. You have some exposure with Deutsche Bank. You need to get paid by them. And it becomes like a big lazy Susan rotating around. And you have a deflationary depression. they fear that. The response to fears of a deflationary depression, speaking about Deutsche Bank, is to give them money, and give them money that's not going to get into the market and cause inflation. But it does cause inflation. And I'm not going to get into the details of it now. It does cause inflation. It is QE. Effectively, it's QE. That money goes into the bank gets made whole, people stop loaning money anyway because they're scared, and then eventually the government has to start printing dollars to ease the debt, to pay their own debt. And what you have is, you have Deutsche Bank being rescued by the whole population paying more for their goods. And that's it. It's either insolvency or hyperinflation, one way or the other.
Alrighty. And another thing I wanted to get your opinion on that we've talked about a little bit in the past couple of weeks, but interesting looking at the Fed's balance sheet, which had been going down for a while. And let's see, we take the long-term lookout, got up to about 8.95 trillion. And then we see over the last year was dropping, and then really has shot up in response to these balance banking events over the past couple of weeks.
So, yeah, this is actually very simple. The people like us are saying they stopped doing QT, they're basically doing QE now. And we're saying, well, look at it, it's right there. We're looking at the Fed's balance sheet, and we're saying the balance sheet is where it was. You know, it's retraced all the way up to 8.7 trillion. So we've undone what, 6 months of QT in 30 days, something like that, or 3 months of QT in 30 days. And so we're saying, look at the balance sheet, you've undone QT. And people on the fiat side of the coin are saying, the Janet Yellen side of the coin are saying, we didn't undo QT, those are just loans, right? So the debt that we bought back permanently, that's in QT, hasn't changed. The money that we've given out is only a loan. So it's a loan. It's a loan. You know, like you give your kids some money and you say it's a loan, you'll pay me back in a week, in a month, in a year, when you're 18, when you get married. I mean, it's a bunch of bull. And what really is happening right now is the QT hasn't stopped legally, but the balance sheet has grown. Yes. And for the next 2 years, that money will be given out to banks to make them whole. And then after 2 years go by, you're going to have either another deflationary crisis or the loans will have to be reloaned out again. So this is the truth. This chart you're looking at is the truth. The chart is that it's a temporary loan. It's a Band-Aid over a bullet hole. And all it does is it furthers the consolidation of banks into fewer and fewer hands. This is a disaster, and it's not going away. It just proves that we have to print our way out of this. That's it.
Yeah, so when you mentioned over the next 2 years, what would you say are the chances we see a balance sheet anywhere lower than here 2 years from now? Or would you expect it's going to be substantially higher?
Let me think about this. That's a good question. That's a tough one. And it's a question I should have an opinion on. 2 years. Okay, using this measure, I don't think we're lower 2 years from now. No, I don't think so. And I don't think we're lower 2 years from now for a couple simple reasons. One, something broke. Something broke. We're not calling it a break, but something broke. And that is the reaction to the first break. If he raises rates again, something will likely break again. That means he can't roll the money off. Third, the problem in Europe is chronic now. And I don't think we're going to be able to offload the balance sheet at the schedule that they want to. So therefore, QE with a side of QT becomes QT with a side of QE. Here's what I mean by that. Between 8.9 trillion and 8.3 trillion, we're going to be in that range. Easy to say, right? But we're going to be running QT, which allegedly lowers the balance sheet. while simultaneously running something called yield curve control, which is raising the balance sheet. So we're going to be in this range, I think, for the next 2 years. And that means the longer we're in this range, the more dollars are getting printed and going into the economy. So yeah.
All righty. And we have another question coming in, which great question from Peter here. He says, how low do you see the gold to silver ratio going?
Oh, can
20
you
to
pull
1, 10 to 1, 1 to 1?
all right, can you pull that up? Do you have that handy?
I will
I
find it.
actually trade that a lot. I will trade that a lot.
So you can begin your thoughts.
Okay, I'll start talking about it. So basically, the gold silver ratio, you have the the natural occurrence of gold to silver in the market in nature. Then you have the gold silver ratio. People will use it as a indicator. When the gold silver ratio is going up, that's bearish for metals. When it's going down, that's bullish for metals. I think, and I believe this strongly, that I'm positioned on that. As gold gets remonetized, which it is now, it's a store of value recognized globally again, as it always has been. As gold becomes a settlement medium or medium of exchange, that makes it trade closer to its scarcity. And as it trades closer to its scarcity over the next 5 years, you're going to see silver track it closer to its natural relationship in Earth. What is the ratio for gold to silver on Earth? What is it, like 17 to 1, something like that?
Keith Newmeyer says it's lower around 9 to 1 of what's actually coming out of the ground right now.
Okay, so let's call it 15 to 1, right? I mean, I don't think, okay. You're going to see the gold to silver ratio for the next 6 months in a rallying market not collapse. Meaning you're not going to see silver gain as much ground against gold as it normally does in a rally, because this is gold and banking fear driven. Silver is as good as gold. It's just not marketed. Now, after the next 6 months and the banking crisis is over, you're going to see the gold silver ratio likely start to get crushed, meaning silver will overperform. The longer this market stays above 2000, the lower the gold silver ratio goes. Now that sounds very facile. What I mean is, the longer gold stays over 2000, the more people say, shit, gold's too expensive, I'm going to buy some silver. You're going to start seeing that. And that's how you get silver to catch fire. On a relationship basis, 90 to 1 is too expensive. And it gets there because central banks buy gold, not silver. And then after it gets there, you see the rest of the world, and I mean the big banks here, not just people like us, going, that's too high. I'm bullish precious metals. I'll buy silver. And you'll see that ratio trade that way. I personally use the gold silver ratio as an indicator. So not an indicator, I trade it. I literally trade gold versus silver. I literally, when I'm bullish, for whatever reason, fundamental, flow-wise, for example, during times of the year, there's a seasonality where demand comes in. I'll see the reports come out in gold that they're getting ready to prime the pump to go higher, and I'll buy silver because silver will outperform. It may not lead it first, but it will outperform. So to give you a couple of numbers, I buy it when it gets to 70. I sell it when it gets to 90. I get short when it gets above 100. I get long when it gets between 60 and 70. Right now, I have nothing on, but the longer, how's this? Here's my next trade. The longer gold stays above 2000, the more likely I am to literally sell gold and buy silver, because silver is going to catch up and someone's going to say, oh shit, silver's too cheap. Or someone's going to say, gold's not doing anything, and they're going to sell it and silver won't budge. So I'm more of a trader on that than an assessor, but whatever fundamentals are, 15 to 1, 20 to 1. Guys, I could say what you want to hear, but I'm not going to, all right? Silver and gold are going to stay at a ratio that doesn't make sense because central banks buy gold. When the central banks are done buying gold, now you can mark these words, the sovereign wealth funds for these countries will buy silver. Then you see silver gold go to 60, 50, 40. I don't think it gets to 15 to 1. I'm sorry. But I don't care, because if it's at 30 to 1 and gold's trading $10,000, I don't care. It's not a competition for me. It's like gold is going up, fine. Then silver's just as silver's more important than gold. The only reason gold's important is because the banks own it. I'm not worried about the ratio. So I'm a buyer. I'm a buyer at 60, and I'm a seller at 85, 90. That's basically it.
All righty. And along those lines, we talked about this a little bit before we hit the record button, but when do you see more mainstream participation in funds entering into gold and silver?
Today. So what I mean is, we'll start with gold. The end of the quarter, end of the month, put gold and primarily gold, but put gold and silver on the radar of these investment funds, these large investment funds. So there are two types of investment funds that are big. One is the one that buys the dips and trades and lets it rally and then sells it. And the other is the investment fund that has a portfolio of assets, gold, oil, silver, stocks, bonds. And they look at their portfolios and they go, okay, which one did the worst last month? Bonds, sell them out and put it in what's doing the best. So you're seeing that today, right now, you're seeing investment funds go like this. The quarter is over, gold's up 18% for the year. Let's take some money out of that piece of crap and let's put it into gold. Boom. That's what happened today. That's what happened during US hours. Now, should it be higher? Maybe it should be. Maybe it's going to take more than one day to do this. The big funds, the first type of big funds, the Paulsons, have been buying since October of last year. The second type of big fund, which is the big fund like the BlackRock that manages money for individual clients in 401ks, they're buying right now. Right now they're buying. But they're patient, but they're buying. How does this spill over into silver? It spills over into silver when silver breaks out. It's all about gold right now, and it's not going to hurt silver, but it's certainly going to help. I mean, look, remember what happened a couple months ago? Silver was going sideways while gold was climbing, and everyone was like, what the hell for silver? Look at what happened the last 5 days. Not today, the last 5 days. Gold chopped around and did nothing, and silver relentlessly climbed for 5 days. That's the big money buying silver. That's the big money buying silver. When gold was doing this, gyrating last week, all last week, gold was doing this. Ended up a little higher, but it was very volatile. What did silver do? It marched every day, very orderly all the way up. The last 5 days, silver was up a couple percent, and gold was essentially unchanged. So I think the big money is starting to get into precious metals right now because of the quarterly close. And silver, while it's lagging, plays catch up if they can keep gold stabilized over 2,000.
All righty, and we have one, or maybe we'll take a few more questions. We'll do a lightning round here. Tony is asking about if you factored in the green demand for silver. I mean, is that something you think that we ever meet any of these mandates? It seems based on the numbers I've seen that it might be mathematically impossible, but any thoughts on that?
Yeah, I got to tell you, I'm confused on that. And I'm not confused. What I am is annoyed. I've seen the math on copper. Everyone talks about copper. Every bank has a report on copper and how much needs to be used for green metals. But no one talks about silver. And I talked to a person in the industry on the bank side, and I said, silver's as green, if not greener than copper. Why are you not talking about that? And he said, well, it's basically solar, and we don't want to talk about it too much because we have a lot of oil clients. That's one thing he said. The second thing he said was more interesting. He said, if we talk about silver as a green metal, That makes people think about gold, and we don't want them thinking about gold because then they think about inflation. So we will focus on copper because it's a pure green play, and we will focus on gold for inflation. But silver, we don't want them to think about gold, so we don't talk about it too much. But if we talk about silver, then it takes away from our copper business. I think the application, I can say this with confidence, the applications for silver in the green economy will grow over time. And I don't mean they're going to use more silver in one battery. What I mean is they're going to find, using technology, ways to use smaller applications over bigger areas. So for example, instead of getting a windshield defroster with copper wires in it, you're going to have a very, very thin cover of silver in the windshield. And that will be your de-icer. And it'll be less expensive than copper to do that. It'll be more efficient than copper. And because of their ability to coat it thinner, it'll be a better application of it. We're not there yet, but we're going to be there soon. Silver's too important, in my opinion. And every time they talk about copper, I think about silver. And that's basically it.
All righty. We have a question. It seems Peter really wants to know if Vince owns any gold or silver mining stocks. Obviously, you don't have to give the inner details of your portfolio, but
no. I don't, Peter. I don't, and I'll tell you why. And I'm not anti them. I'm ignorant of them. In fact, I'm talking to Chris more about this behind the scenes. When Paulson bought in 2011, I went big in on gold stocks, GDX, and I went in blind. I started going around to investment conferences, like looking for private investment in mines, like brownfields and things like that. And I walked away from those investment conferences a little disappointed, because I didn't understand what's going on. And I know the commodity, I don't know the mines, because here's what I mean about the mines. It's really not a commodity when you get to the mine. Buying GDX or buying a portfolio of silver mines, it really is not just something you do lightheartedly. And while I have a background in fundamental analysis, I'm not there anymore. You need to know the management. You need to know the company. You cannot look at, that's a tech company. Like, silver and gold are commodities, right? But silver and gold management is not a commodity. You really have to know who you're talking to and what you're talking about. And so, to answer your question, I have very little silver and gold mining speculation. I have very significant silver and gold physical, because I trust myself to hedge my silver. I trust myself to hedge my gold. But you show me a good manager that knows how to hedge his production, that knows how to hedge his operation, and I'll buy it. I just don't. I haven't spent a lot of time focusing on it. And I think it's because I got burnt in 2012, and so I've been once bitten, twice shy. But I'm open to learning.
Well, appreciate that. And last question before we share some of your coverage of Janet Yellen's excellent new book. Sam, I am not says, how drastic would the black market value for precious metals be when things really hit the ceiling fan? Interesting question, especially if we do run into some sort of situation with the COMEX where things aren't trading. Do you imagine seeing some sort of black market environment and bartering? And how do you see that playing out?
Well, we have a gray market now. The price of Shanghai gold is like 7%. I'm sorry, 5 to 7% higher than COMEX, which and that price is getting out. It's becoming more transparent in the world. And so what you have is a gray market, and that gray market is buying gold in the US, taking delivery, and then shipping it overseas to sell it higher. That's your gray market. And that has been draining COMEX silver for the last 2 years, probably courtesy of India, right? And that's an arbitrage. That's somebody who's out there not playing well with the Fed, the US Fed, has been taken care of. With regards to a black market, I think you're looking at what happened in Kashmir, like back in the old days. Like the gold would go through Kashmir on a camel's back from one side to the other. I had some experience trying to get into a gray or black market. I was going to open an operation in Brazil at one time. I had an operation in Argentina, and I was going to open an operation in Brazil. And the idea was Brazil doesn't let gold leave. The idea was to take delivery there because it was cheaper and then get it out. And the gold and silver black market, they exist, and they'll grow as the price goes up. But what you'll see in silver before there's a black market is you'll see scrap innovations come out of the woodwork. You'll see old solar panels be recycled or what have you. I don't think you're going to see a lot of black market behavior for silver because it's too important industrially, at least in the US. You're going to see it over in Asia though, that's for sure.
Alrighty. Well, Vince, before we wrap up, first of all, a lot of people really appreciate everything you're sharing there. I see some Vince is awesome, Vince is great. So certainly I agree with that. Maybe I'm a little biased, but like I said, before we wrap up, I know that you are a big Janet Yellen fan.
I am.
And you actually recorded some thoughts on that last night. So I'm going to pull this up and we'll play. This clip is about 2.5 minutes long, and we'll get any final thoughts before we wrap up. So here's what Vince sent me last night.
Now, speaking of Janet, I promised a review of her recent book. So before we get right to that, the reason I was interested in her book was because.
By the way, I have to say this is pretty exciting watching Vince react to Vince. Very circular in there.
It's ridiculous. Okay. I had always been a fan of
Vince. You like this guy? What do you think?
I think he's annoying as a economist. He's okay. And consistent, stalwart in her behavior under pressure. And then the banking crisis happened, and she lost her composure. She kind of messed up, and it made me concerned. So I went out and I ordered her book, right? And you know how people love to do these unboxing videos. So here it is right here, right? And it's a special book. It's a special order that I got here. So let's get right to that. All the internet kids love to do these unboxing videos. Now, I'm too old to get all excited opening box, but I'll do it for you because there's a little something extra inside with this book. So let's get out our letter opener.
Like that you used your machete to open Janet Yellen's book there.
Yeah, that's my uncle's Marine bayonet. Okay, so here's the book. Great. Empathy Economics, right? Janet Yellen's remarkable rise to power and her drive to spread prosperity for all. This is the Janet that I fell in love with. And I wanted to find out, I wanted to touch base with that. So we're going to take you out with the review of the book that restores my confidence in the ability as well as the integrity of the offices and people that are managing our futures here. Why don't you enjoy this review?
Vince, any comments before we see the actual review that I think people will be stunned by?
I think you said it was pretty hot.
So there is Vince's review of Janet Yellen's new book. Vince, it looks like you were quite a big fan. Actually flipped open a page to read as you were roasting it there. Did you at least cook a steak on it, or?
No, I almost had to go to the hospital. The lighter fluid was so strong. It wasn't hot enough for me, so I threw a lot of lighter fluid on there. I needed more light. It was getting dark. But I would burn it again. It was good.
Okay, so Did you actually read much of her words before you grilled it, or any last thoughts on the book before we
Yeah, I
close out
mean,
today?
I can do a series review of it, but I started to read it and I got sick. And I was kind of goofing off on my love of her, but the reality is, I thought she at least believed what she was saying all those years. I thought, okay, I don't like her. I don't like her politics. I don't like her economic skills, but I thought she believed in it. When she was in front of that panel and said those ridiculously stupid things that only enabled more bank runs, I went, she's a moron. And everything else didn't matter anymore. So to answer your question, I started looking at the book. I read the first couple paragraphs. I noticed that the type was really big, like, and the words were very, I don't know, like mush. And I stopped reading after 2 pages. I really did. I mean, it was horrible. It was a horrible book because of what she's done.
Well, I hear you, and I can only imagine getting through that one. I did read Paul Volcker's book a couple of years ago, which was interesting. And Vince, I think we're going to get close to wrapping up here because I know obviously for your afternoon what you have planned, and certainly don't want to hold you back from this one with Ben Bernanke's fantastic book
I'm,
that came out recently, The Courage to Act, and bring us into hyperinflation, as obviously we might not be far off from him getting up in the helicopter. I think
we're
that's
not, we're
priced
not.
in for this year's December meeting. Excuse me. Although Vince, just before we wrap up, again, I will mention that Vince runs Goldfix Substack. Link to that in the description field below, where he covers all of these economic events that are coming out on a daily basis. And Vince, any final words before we wrap this one up, my friend?
A lot of people say keep the faith. It's going to come back tomorrow, something like that. I'm not saying that. It's here. Don't worry about it. Just buy dips and don't worry about it going lower, because it has to go up. These markets, they have to inflate. If they don't inflate, it'll all crash. And we're in the right space now. That's it. Everyone's good. Stay long. And I'm praying for a dip. Really, I am now. That's it. Let's go.
Well, sure appreciate that, and appreciate everyone who logged on today to watch and ask some questions. So Vince, I won't hold you back any longer. Go get him with The Courage to Act by Ben Bernanke himself.
Is that my homework?
I mean,
I'll do it. I never read it. I never read it. I'll read it.
Well, you can get this one. This is the audio book. Although unfortunately it doesn't seem like Ben read it himself. That would be great to hear his voice for 10 or 12 hours. But either case, we will wrap up there for now. So thanks for everyone who logged on. Thank you, Vince, for being a part of the call today. And hope everyone is having a great day out there. Enjoyed this, and we will see you again tomorrow.
Thanks.